Okay, everybody, welcome to our special session today. We are very, very happy to be doing this on quite frankly, on really short notice, because as many of you know, all this information came out for the personal real estate corporations on October 1st. With a lot of the info that both the brokers and the real estate agent needed to know. And we've been making lots of phone calls over the last couple of days and reading in order to move forward. So for those of you that don't know me, my name is Gary McGowan. I'm the general manager here of the Keller Williams Realty Centers brokerage in the Newmarket, Aurora, Georgina area. And we're happy to be joined by the Keller Williams Brokerage Integrity out in Ottawa. And Andrew, who will introduce himself in just a moment, is the team leader out there. And so as we've all been on Zoom meetings, there's a lot of information that our guest, Steve Parker, will go through today. And we ask that, of course, you keep your microphone muted. I'm sure that we'll have opportunity for questions at the end of his presentation. And I know Marvin is online with us, and he's got lots of things and lots of ways and ways to input here as well, with his tremendous experience in setting up corporations and so forth. So we are truly at that time. Andrew, Marvin, and I were having a conversation earlier, and we truly feel this is one of those moments in a real estate career where you get that little golden nugget and you just kind of alter or shift your real estate business. And we truly do believe that using this appropriately can really just set you off on that brand new trajectory. So we're really excited about what this is going to offer real estate agents in Ontario. And quite frankly, we're really excited to see great real estate agents are creative, and we want to see some creativity coming out of this as well. So we're excited to obviously be in partnership with you along this journey as well. I'm going to hand it over to Andrew Ouellette, as I said, the team leader at Keller Williams Integrity in Ottawa. And over to you, my friend.
Thank you. I think I'm going to screw up Steve's screen here because I wanted to introduce. We've actually made this into a series. So we have Steve here to talk today, giving us an accountant's perspective. And then I'm going to share my screen here briefly, and hopefully we have no problem getting it. Did you make me a co-host, Gary?
Yes.
Okay, perfect. So we have two more people coming to speak. One on Friday, Vicky Ling is a financial planner, so she's going to talk about the opportunities in a PREC, looking into the future as far as estate planning, wealth building, and retirement. And then next Tuesday, we have Andy Scott, who's a lawyer, who's coming to talk about how to set up the corporation and the opportunities to reduce liability, et cetera, and et cetera. So, like I said, we have Vicky Ling, and we're happy to kind of keep some of this in-house as well. Vicky's a phenomenal representative, but she's also the wife of one of our agents here in Ottawa. She's a very impressive woman, so she's got lots to share with us. And then Andy Scott might look familiar to those of you in Ottawa, is Chris Scott's brother and a lawyer here in Ottawa, who's really dug deeply into all the new legislation and the opportunities around this. So we're excited to have them on this Friday at noon, and then next Tuesday at noon as well. So hopefully we can get your slides back up there. No problem, Steve. Sorry about that. And Marvin, I believe you wanted to introduce Steve. And
I do. Thank you. So first of all, welcome everybody in Ottawa as well as in York region. It's a pretty exciting day and time for us in real estate. We've been waiting for this for a very long time. And of course, welcome to all the people outside of our brokerage that are joining in to get value. And we're really quite honored to have all of these top professionals speaking to our offices over the next few days. And I do encourage everybody to attend all three portions of this, all three segments of this discussion regarding personal real estate corporations, because these are the things that really you need to think about and to plan appropriately. And often we get busy with selling real estate and we don't focus on some of the important fundamentals. And Steve, as an example, is an excellent accountant. He's a CPA, he's a CA, he's the managing partner with Parker, Prins, Lebano. He's been our accountant in Ottawa for KW for about 13 years. I recently hired Steve to be our accountant for Keller Williams Realty Centers. He's also my personal accountant now for all of my corporations. There's 12 of them. So I can tell you that I do have a lot of faith in Steve and what he has to say. All of the professionals that are speaking, I don't know Vicky, and I'm sorry, Vicky, I see you on the screen there, are based in Ottawa. So they're able to get some very, I wouldn't say insider information, but they're really on the pulse of what's happening in the nation's capital, which I think is advantageous for all of us as well. That's quite exciting. So, it's important that we get this information out to you early. I believe that we are cutting edge. I don't know of any other companies that have launched anything like this so quickly. We are learning as well. So one of the things we're going to take from listening to all of our esteemed speakers over the next few days is our rollout of the Personal Real Estate Corporation from a company perspective. So we want to make sure that we're going to have the proper forms in place, because there will be RICO audits. They're going to want to make sure that we're paying you correctly and that you're properly remitting. So we're going to make sure that all of our questionnaires, our systems, our tools are in place as quickly as possible to protect everybody. So it's an exciting time, and quite frankly, there should be hundreds of people on this, but I commend those that are on it. We will be recording this and sending it out for those who were legitimately unable to make it, for sure. And so I guess with no further ado, it's a good time to introduce Steve. So I reached out to Steve when we first heard about the bill passing, and he formulated a very eloquent response. And we do encourage you to submit your questions in the chat area, and we'll probably have some questions for Steve along the way as well via both Gary and Andrew. So with no further ado, I'd like to introduce you all to Steve Parker. Steve, take it away.
Great. Thank you, Marvin, for the introduction. Everybody can hear and hopefully see the slideshow. I will try to be quick but thorough. There's an awful lot of issues that we could be talking about for hours and hours. So corporations for professionals have existed for quite a long time. You're one of the last professions to actually get corporate rights. It's nothing to do with the federal government. They don't care what kind of business you're operating in regards to corporate status. So a personal real estate corporation is a creation by your professional body. It's not a CRA issue. Your professional body will have rules and regulations over what you can or can't do. CRA has no say in that. You're under the same corporate laws that a hot dog stand is under, or in regards to taxation theory. So I will talk a lot about the taxation theories today. Try and eliminate some of the myths that exist and try and give you some practical advice on how and why you would want to incorporate, what point. Everybody's situation is different. So again, I'm going to get into it and make this very, very clear. It's not actually extremely complicated in how corporate taxation works. And your federal and provincial governments have both been very favorable over the years in reducing corporate tax rates. So a corporation on profit that is retained in the corporation applies to the first $500,000 of profit. Profit is after expenses. Faces a corporate tax rate of 12.2%. Individually, when you're unincorporated, which you currently basically all are, you face personal tax rates that start at 21% and go as high as 54% in Ontario. And even when a corporate profit exceeds $500,000, that profit is taxed at 26.5%. Still very favorable to the personal rates. And this is one of the areas, talking about Trump in the U.S., trying to get U.S. corporate tax rates to be as low as Canada. Canada has some of the most favorable corporate tax rates in the world for a taxation authority to encourage entrepreneurship. And the 12.2% rate was 21% 10 years ago. So federal and provincial governments have both brought them down. I suspect we won't see any declines because of the pandemic, but certainly I wouldn't expect much of an increase here. We need to encourage entrepreneurship. So paying 12.2% tax is certainly favorable to paying 54% tax in the short term. That generates a tax deferral by paying less tax now and gives your corporation more capital to use to grow your business model. So if you are hiring employees, you will have more capital to hire employees by paying corporate tax. If you are investing in marketing and equipment, so growing your business is always easier in the corporate form because you have more. It's just not a very hard concept. More capital by paying less tax gives you more potential for growth. If you are not growing your business and simply are earning income to live and are not going to be investing in employees and buying buildings and buying office space and equipment for your growing business, then you can invest passively in your corporation by opening up an investment account or maybe buying some kind of another asset. You'll have, again, more capital to invest. So that concept, I think, is relatively straightforward. It's just make sure this means corporate profit left in the corporation. So if you draw the money into your personal hands, you are going to be faced with a personal tax liability in the short term. So you can, an example, earn $200,000 of profit, take out 120 personally, leave 80,000 in the corporation. That 80,000 is taxed at 12.2% instead of the personal rate would be 50% on that level. I have some examples later on in the mathematics here. So nothing magical. Your government is stepping in and saying, we want you as an entrepreneur to reinvest profit in your business, create jobs, stabilize the economy, all those variables. And the low corporate tax rate facilitates that. This only applies to active income. Your real estate brokerage income is active income. If you go out and buy a rental property, that is not active income. So these tax rates only apply to active income. Active income really means what it sounds like, a daily physical activity to earn the income on a regular basis. So passive income is not. Corporate earnings also do not attract Canada Pension Plan payments. So Canada Pension Plan payments for a self-employed individual, which you have no choice in the matter when you're unincorporated, approximate 10% of the first $57,000 of profit. So about $5,700 per year has to go to CRA for Canada Pension Plan. Nothing wrong with that if you have lots of money to invest, but if you'd rather invest the money in your own business, the corporate model offers you an option here on that. So tax deferral, we're talking about here. Next slide, please. You can also avoid the Canada Pension Plan on the earnings you pay to yourself personally through a corporate model. Corporate model is the only model that allows you to earn active or business income and compensate yourself in a manner that does not attract Canada Pension Plan. I'm not saying that's the right decision, but certainly if you're trying to grow your business or cash flow, I could call it what it is about 80% of the Canadian population borrows money on credit cards to fund CPP payments. And so your government forces you to pay Canada Pension Plan at $3,500 of earnings. You haven't paid for your groceries and you're saving for retirement. So Canada Pension Plan has a lot of flaws in it that way. The corporate model gives you the only out clause to say, I'm going to earn income from working, but I will not pay myself a salary or a business fee. I'll pay myself dividends. Dividends do not attract Canada Pension Plan. So again, when you're building your business up, or if you're struggling financially, a pension plan contribution may be one of the last things on your priority list. The corporate model allows you to exempt out. A question came in, how many years maximum can you defer to? In regards to, I assume that's the tax bill. Tax bill can be deferred until you die, is the basic answer. You can pay corporate tax year one at 12.2%, leave that money in the corporation, invest it, and until you touch it personally, you do not have to pay the incremental tax. When you pass away, you will be deemed to sell the business for the value, so you'll pay the personal tax bill upon death. So again, dividends do not attract Canada Pension Plan, but here's a but here. Your government's I give your government some credit. They do have some bright people in there in some of their areas. They link the Canada Pension Plan earnings to the RRSP model. So if you pay yourself dividends from your corporation, while you will not pay Canada Pension Plan, you also will not generate new RRSP room. Again, if you can't save for retirement, neither one of those are relevant. But as a strategy, when you have the capital to save for retirement, the RRSP room becomes attractive, then dividends become less attractive. One of the big reasons why we always form corporations is the next point, a potential for income splitting with family members by paying reasonable dividends to family shareholders. Your professional body is allowing non-voting shares to family shareholders. So you will have this option. A couple of years ago, Trudeau and Morneau went around Canada with a so-called attack on small business. And one of the areas they did leave in their changes they were threatening was the ability to challenge dividends paid to family members that are unreasonable in the circumstance. So they sort of hit on this issue. So legally, you can pay a dividend to any shareholder in the company. Income tax-wise, CRA has put together some ridiculous, I call them ridiculous, challenge tests on dividends to family members. I've never seen the test ever applied yet. It's been a couple of years, so who knows what we'll see. But the point there is that we used to use corporations like crazy to pay $45,000 dividends to university-age family members. So tax savings are substantial by splitting up income. Here's the concept here. Canada has graduated tax rates per individual. So I'll give you a mathematical example. If you have a family situation where one person earns $200,000, it's all on their tax return, the tax bill would be in the range of $65,000. If you had four people, husband, wife, and two university-age kids, and each received $50,000 of income through a dividend issue, same total family income, tax bill would fall from about $65,000 down to around $35,000. Okay, Canada's tax system has a flaw in it, in that if one person earns all of the income, the tax bill is higher than four people earning the same income. In this regard, income splitting has never been heavily challenged by CRA, even though theoretically they could. The dividend challenges that exist, some accountants will say you can't pay dividends to family shareholders. Well, there's no rule saying that. The issue is, can CRA challenge them for being unreasonable? The reasonableness tests they have don't make a lot of sense. So it's a bit of a gray area here as to how much benefit and risk you will take on. Certainly, if you have a spouse working in the business with you, no risk issues. If your kids are working in the business, no risk issues. What age? A question came here. What age can we start to employ our kids? Now, employing your kids can start as early as you feel they are doing work for you. There's no age for employing people. In regards to paying dividends, which is a shareholder issue, a shareholder must be 18, to subscribe to share must be 18 years of age. But you can pay salary or consulting fees to your kids when they are younger than that. So dividend income splitting, big issue. But some people will think it's less of an issue now. Bottom line is you will have this option. My personal opinion is government will pay very little attention to this issue, but other accountants don't feel the same way. We've been doing income splitting with salary to family members for years with no challenges. Dividend income splitting is not really much different, but it doesn't attract the CPP. A key issue on one of the real values in incorporating is income smoothing. And this is a bit of a misunderstood topic, but it can be very important in an industry like yours where earnings can obviously fluctuate. I know you're into a real estate boom period right now and things are going very well, at least for many of you since the summer. We also had a terrible part of the start of the year. Earnings can fluctuate in your sector. I think you all know that. When earnings can fluctuate, the personal tax model can have ridiculously unfavorable results. The corporate tax model will allow you to smooth the income. So the concept here is that you will pay corporate tax when the funds are first earned and pay personal tax in a year where your personal tax rate is lower. I have a mathematical example at the end of the presentation, but think of the concept. If you're facing 54% tax this year because you're having a great year, and your tax rate next year would be 30%, you'd love to shift the income to year 2. There is nothing in the personal tax model that allows that shifting or allows any averaging. The last averaging concept that existed in personal tax existed the year I started working in 1987 in the accounting profession. It was the last year. It was called forward averaging. So there is nothing you can do to shift income personally beyond being fraudulent. In the corporate model, you have a completely legitimate shifting process to not tax income inappropriately in regards to tax rates. So similar to what an RSP does the same thing. If you earn $100,000 in a year and put $50,000 in your RSP, you will pay personal tax on $50,000. The other $50,000 that went to your RSP will be taxed in the future when you draw the money out of the RSP. The corporate account works exactly the same way. You will tax it later on. Yeah, that question that came through, there was one question about establishing a value of your business when transitioning to be addressed later on. Came through. So income smoothing is a tax specialization concept. I pick up clients all the time who are improperly income smoothed. And so it takes creativity. It takes a little bit of forward looking. It takes some thought process. It's like you're deciding on when is the right time to buy the house. The price points will differ. Taxation has a price point. That's your personal tax rate. So it takes a little bit of effort. So we're talking about when you buy corporate tax preparation services, to buy them from people who are qualified. Preparing a corporate tax return is not optimizing a position. Tax optimization is a skill in itself. I know you're talking with the lawyer, Andrew. There's always some level of liability protection by incorporating. In many people's case, it's the number one reason why you incorporate. The word limited in a company name implies limited liability. How much a corporation protects you depends on all the circumstances around the transaction flow. The lawyer will comment better. Professional corporations tend to have limited protection on liability issues to make sure you're still held personally liable. But other things do happen in your business life. I assume in your industry, there are people walking through houses. Who gets sued if somebody has an accident? Everybody gets sued. You're better off having a corporate model around you than a personal model in those cases. So your lawyer will comment more on that. Safe to say there is some level of protection a corporation will generate for you. It'll generate protection. Here's one it will generate protection for is income tax issues. So for example, right now as an unincorporated individual, you are assessed personal income tax on your earnings. If you can't pay the personal tax bill, you're dealing with a personal bankruptcy issue. If you're a corporation, you will have corporate tax and personal tax. The bill will be split. A lower personal tax bill, part paid in corporate. Corporate tax does fall under corporate bankruptcy law. Does not follow the director. So automatically you all gain some level of tax protection if you have a corporation for your tax situation. This next point should never be listed by me. It is a practical tip in that corporations inherently, this is baffling, but it's reality, draw a lot less audit attention than individuals do. And there is no rationalization for that beyond your own government's laziness. We file about 4,000 personal tax returns a year in our firm. 35 to 40% every year see some level of inquiry by CRA. We file 1,000 corporate tax returns per year and less than 5% see any inquiries. Quite often the corporate numbers are much bigger, much more substantial. It's a low-hanging fruit theory at CRA. Corporations tend to have lawyers and accountants, have a little more expertise in knowing how to deal with CRA. Individuals do not. It's a laziness factor. I shouldn't say this point because it's not theoretical. It's just the results that we see. I have clients who come to me, they're salespeople. Every year, CRA will audit their salesperson expense on their personal tax return. We have their employer flip them into a corporate model, pay their commission to their corporation. The expenses never get looked at again. Same expenses, same tax relief. It's baffling results, but it's just the reality. It's not supposed to be this way. But you may see a dramatic level of lower level of inquiry. Big point for incorporating, and I'm not sure some of this might be beneficial. One of the number one reasons to incorporate, number one reward for entrepreneurship is the capital gain exemption on qualifying small business shares. Basically, if you're ever able to build up your business to the point where you could sell your brokerage firm to another broker, so then you would have this exemption available to you. So if you sell an unincorporated business, there is no capital gain exemption. If you sell the shares of a corporate business, each shareholder has an $850,000. That's a current exemption. That's approximate. It goes up by inflation each year. So if you were to sell your brokerage firm for $850,000, you would not pay any income tax. Now you'd say, well, this sounds too good to be true. And it's also something that the government will close this. It's not a loophole. It's one of the motivators for entrepreneurship. The government's only increased the exemption substantially over the year. It used to be $500,000. They've increased the exemption. If they ever did pull it, they give you one last chance to use it. So bottom line is that if you are successful, eventually all businesses get sold. Whether it happens when you pass away, if you haven't even sold your business, it's deemed to be sold when you pass away. So a corporation would protect you from capital gains tax in all of these cases. So it may be a reason why you do that regardless of the other benefits. You won't see this benefit until you sell your business or passing away. But it is a very large one. We put through 25 to 50 client situations a year where they receive an $850,000 check and pay zero income tax. Yeah, that sounds too good to be true. Well, again, Canada has leading edge corporate tax rules, all rules for, you guys are entrepreneurs. Every tax incentive rule written for an entrepreneur is written for the corporate model. Yes, the 800 question came through. Okay. Is the capital gain exemption applicable to each shareholder? Yes, but they must be ownership shares. So equity shareholder, that was second question. So in your case, I believe the equity shares will only be held by the broker. And so you'll have one exemption available. Now, that's interpretive. Okay, I'm going to tell you a story about this one. Maybe you are the broker, but your spouse is heavily involved in your business model in regards to what they do with you, helping you finance the business. In that case, you can argue that even though they're not a legal shareholder, The attribution rules for tax say who really owns the shares. Is it a joint business or a single business? So in that case, you could possibly double the exemption, even though your spouse does not legally own shares. Okay, another question came through. Would the exemption also apply if someone sold their real estate business in such a manner they receive the benefit of the sale price over time? $100,000 up front, then 20% of all future sales over time. It's a good question. The fundamental answer is yes. Now, you can sell your business and be paid over time, and the exemption just kicks in each year. So you got paid $200,000 a year for your shares. You get $200,000 exemption per year. The only cautionary point is that if you have a payout that is linked to future sales, you're giving CRA an opening to say that payout is not capital gain, it's business income because it's contingent upon something happening in the future linked to sales. So I have lots of clients who sell over time. We claim the exemption. Nothing's looked at. That's not success. That's just getting lucky. If you're paid over time based on future sales, there's a risk element that the payment over time is not capital. It is a payment of income, therefore not qualifying for the exemption. That's a risk issue. Certainly, it's take your risk, but if you can be paid for the shares, defined amount, the exemption is solid as can be. If you are paid for the shares based on things happening in the future, the question is that business income or capital gain? It's a gray area. Give CRA a window to attack it. So it's a risk factor. Next slide. All right, so it's not all road. So the corporation, before we sort of leave the benefit side, the corporation, again, all tax incentive rules are written for the corporate model between low rate corporate tax, capital gain exemptions. There's bonusing deferrals. A lot of things I didn't bring up. They're not really substantial. One thing I want to make clear before we leave the advantage area is paying yourself dividends. So this is a big myth that I will save tax by paying myself dividends. Now, dividends are integrated in the Canadian Tax Act virtually down to the dollar. So when you own your own company, when you pay yourself dividends, you pay a combination of corporate tax and personal tax. Combination of the two. The combination of the corporate and personal tax would literally be identical to the tax you would have paid on salary or other earnings, such like your currently unincorporated earnings. So your tax bill is not being saved by paying dividends. The Canada Pension Plan is saved. That is without question. The dividends allow you to smooth the income over 2 or 3 years. That's the tax savings. Or pay to a lower income family member, the income splitting. Dividends themselves do not save tax. Now, somebody's going to say, wait a second here. I get dividends from my Bank of Montreal stock account. My tax rate is lower. Why? Well, because Bank of Montreal paid corporate tax first. You didn't care what Bank of Montreal paid, really. In your case, you're going to write a corporate tax check to CRA and a personal tax check. Add the two together, gets you your total tax bill. The dividend tax bill is identical to the salary tax, literally identical. For a while, there was about a 1% to 2% tax preference for dividends. Dividends inherently have no tax savings. They have Canada Pension Plan savings, and they have income splitting potential, and they have a little more tax deferral flexibility. That was the income smoothing area. Okay, but you're not incorporating so you can pay yourself dividends to save income tax. That is a myth. And I'll give your government credit. They've actually integrated the Tax Act, and a combination of corporate tax and personal tax is virtually identical to a salary position. So the big disadvantages of a corporate structure, the cost is the number one disadvantage. It's really only the real disadvantage worth talking about. So to form your company, again, there are 3 ways. Well, there's 2 ways to incorporate a company. Do it yourself, or do it through somebody else. The do it through somebody else has options, but call it do it through somebody else. So like we incorporate companies for clients because we do the tax structuring. Lawyers incorporate companies for clients, right? Lawyers tend to be the most expensive version, most high price cost. Government fees exist to be paid. I'm not sure. I have not checked to see if you guys have to incorporate provincially. I wouldn't be surprised if you have to have a provincial corporation. It means nothing tax-wise. Provincial corporations have more government fees to pay than federal corporations, but government fees anywhere between $200 and $400 to incorporate the company. That's payable once. If you have a federal corporation, I'm not sure if you can here. It's not an income tax issue. It's your college issue. Federal corporation incur a $20 filing fee per year. Provincial corporations do not. The rest of the cost is the professional fee if you don't do it yourself. I'm not sure. I haven't read. Will your college charge? I call it your college. Your professional body charge a fee. A lot of professional corporations under their college, it's one more chance for your college to ding you with a fee. So in my profession, we do not pay annual fees for my corporation. We had to pay an upfront fee. Doctors pay an annual fee to the college of physicians that have a corporation. So will your college hit you with a fee? I don't know, or your professional body. Okay, they probably will to get it running for their blessing. They may or may not annually. I don't know in your case. I haven't looked at your details. So the costs, the one-time cost, $500, $1,500 to form it. The bigger cost is the annual cost. To get tax optimization done properly, and the fact that you have a corporate tax return, and a corporate tax return requires a balanced financial statement for your business. So in a personal tax return, which you're currently doing being unincorporated, you list revenues and expenses. That's my profit. That goes to my tax return. In a corporate tax return, that same transaction occurs, but it must be balanced to a financial position statement. So it's a little more work. The bigger part of the work is the tax planning, and that to optimize your position. What is the optimal dividend, salary, corporate tax payment? Distribution over 2 or 3 years takes some expertise. So again, like anything else in life, if you cut corners, you can lower your costs, but will you get the results? CRA will never optimize your tax position for you. So you would want to budget. You could spend less than this. You can hire unqualified people who do your corporate tax work for $500 a year, and it'll cost you $5,000 in tax, but you'll save professional fees. You won't save any money usually. I have situation coming to me from unqualified suppliers who, I use the word butcher the tax situation up in regards to dramatically overpaid tax bills over time. I had one client come to me who deals with a CA from Algonquin. He's a professor at Algonquin College, does a little bit of tax work at night. He was costing his client $25,000 a year in tax issues. He did not know how to optimize a position. So I encourage, if you're going to take the time to incorporate a company for these benefits, make sure you achieve the benefits, which is hire appropriate skills in this area. Just because somebody does corporate tax returns does not mean they do corporate tax optimization. You can buy a software program to prepare a corporate tax return at Staples. You're not going to be able to optimize the situation. Administrative time, you don't really have anything else to do here. You're going to have to open a corporate bank account. All right. And, whether you have employees or not, it's not a corporate issue. Whether you have HST returns is not a corporate issue. These are all issues of your business structure. So will a corporation add administrative time? When you talk to the lawyer, they may tell you, and I'm not downplaying what they're going to say, but I'm being practical. A lawyer may tell you of all the following 15 steps that must occur every year in your corporation. 99% of small corporations are non-compliant every year in those areas and suffer absolutely no consequences. It's like jaywalking. Right? So there are corporate requirements that most people ignore that have no impact to them. So, but if you did follow all the lawyer recommendations, minute book updating, director's resolutions, most people don't bother, but the lawyer will tell you have to. You'd spend a few hours a year on that stuff. If you want to, use your lawyer and get it done. Most people don't because there's no real repercussions to not doing it, but they are legal requirements technically. This is the question that came up, I believe, earlier about valuing your business when you transfer it to a personal real estate corporation. Under the Income Tax Act, this may sound like a bunch of nonsense, so I'm trying to tell you what is rules driven and what is requirements. Is you are when you transfer your business to a corporation, you're deemed to sell your business to that corporation. So if your business has value in its goodwill, in its name, and this is always a gray area, if you do not file tax rollover documents that year, you are deemed to sell your business at its market value, and you would trigger a capital gain, which would be 1/2 taxable. To defer that capital gain until you actually sell the business, you file a Section 85 rollover tax filing the year you incorporate. Now, you have to somehow value your business and then document. It's not a very complicated process in your situation, but it is something that if you don't do it, if got looked at, would have a tax bill on a deemed capital gain. Now, if the business is just you and you're starting out and you're fairly young in the process, not much of a factor here. You probably don't have any real business value. If your business is well established and especially if it has employees, so you're making money off other people's time and that, it's certainly going to have some business value. So the rollovers get much more important the larger your business. Your exposure is much greater with a full business model than I'm my own individual and I work for myself kind of approach. So there's some risk here that's marginal for many of you and bigger for others. So again, looking after it. Your business has to be valued by somebody. You can do that pretty quickly. Okay, I mean, a few questions coming in here. Can commission earnings already held by the brokerage firm for completed transaction not yet paid to the realtor be paid to the new co once created? Or can the realtor assign an income new co? Well, there's nothing stopping as long as your brokerage firm above you will pay to your corporation. The Income Tax Act, I don't want to get into too much theory here. The question here is, when does a broker earn income? Is it when you are paid or when a firm offer and acceptance is generated? So if CRA could argue that you earned your $15,000 commission, not it was paid to you, you earned it when the buyer and seller agreed to the house closing, then that income would be personal income earned prior to incorporation. In this regard, let's call it what it is. If brokerage firm pays your corp a commission, okay, the deal was signed in August, closes in December, you're incorporated, pays it to your corp. What are the chances of CRA challenging you? Microscopic. So, but if they wanted to make life miserable, they could argue that you actually earned the income back in August when you did all the work to sell the house and the deal was signed. So I would leave it at that. It's a minor risk element if it's paid to your corporation afterwards. Tax roller. Best to not simply transition to a current corp and create a new one. It doesn't make any difference. If you already had a corporation in existence, to save on the incorporation cost, you could use that one, change the name, and you save that cost. You can roll over into that corporation. The only issue, whenever you have an old corporation you're using, is you're picking up any skeletons in the closet there. So you want to make sure it's clean. It's like buying a used car versus a new car, right? I mean, a new car shouldn't have as many problems potentially, and it could, but a corporation, you acquire what's there. A new corporation has nothing in it, so you know it's clean. It's a brand new clean slate. An old corporation could have tax issues, could have legal issues, not likely. So do your due diligence if you want to use an old corporation. Otherwise, you can certainly transfer your unincorporated business to any corporation you want to. Okay, I made some, these are just general comments here. Oh, that question came through. Can a management corp be rolled, turned into a personal real estate corporation? Well, again, your college, the corporation, for tax purposes, doesn't matter. Okay, for tax purposes, a corporation is a corporation. What your college will accept, I assume if you had a clean slate in there, and you change the name, their college likely would work with that. When we actually do incorporations for doctors to help them out, and so we have to do is send to the college the incorporation document. So they have to see that you have a corporation and the right name to it to approve it. So I don't see why they wouldn't, but I can't speak for your college. You certainly have to make sure it has the correct name and the correct share structure, i.e. the only shareholder is the broker. All right. Question here. Sorry, next slide is going to be on general considerations. So again, keeping in mind that the biggest value in your corporation is the tax deferral, tax savings issues, and that is an annual optimal income distribution calculation. And so my comment there, reiterating it again, is do not form a company and then become a do-it-yourself tax preparer unless you're really skilled at this stuff. If you're skilled at it, you can do anything you want. Or hire somebody who is not skilled in this area. And unfortunately, corporate tax services are not regulated. So anybody who wants to say they are a corporate tax specialist can say that. Right? So there's no barrier to entry in providing corporate tax services to the public. Obviously, accredited accounting firms have a much greater chance of optimizing for you, but make sure they actually specialize in small corporate work. If you went to Ernst & Young, you may not get optimized. They do not specialize in small corporate work. They have somebody there who could figure it out, but it's not their area of expertise. So let me tell you the stats. 90% of graduating CPAs have limited tax knowledge now, because the program is geared to cater to the entire business industry. So you assume somebody has a CPA, they're a tax expert. You never make that assumption, right? The program is geared, you can get your CPA now working at McDonald's in their head office, not ever touching a tax return. Okay, so it's not a guarantee. We would have to know the individual specialized in that area. The share structure of your corporation has to be looked at. So again, this is in part of the initial forming when you can have non-ownership, non-voting shareholders who is brought into that mix. It's a lot easier to do it right at the start than having to re-renovate the house later on. So you're building a house here. You rather build it properly than renovate it 2 years from now. But you can always change it and fix it. You can always add on new shareholders for dividend flexibility. One question that comes up all the time is, what kind of investments can my corporation hold? Okay, under Revenue Canada, they couldn't care less what you did with your money. Okay, there's no tax restrictions on how you can invest your capital. Your professional body may have some limitation. Generally speaking, they do not, beyond investments that would be against the reputation of your profession. Because they want you to have something. The reason why they're allowing you to incorporate is to have these advantages, and to have the advantage will have money in your company. Check with your professional body. Most of them have very few, if any, restrictions beyond doing things that don't bring a poor reputation to your profession. Okay, so illegal activities. CRA doesn't ban you from doing illegal activity, but your professional college may not like it. So things like that to watch for. And I'll talk passive investments in a corporation. So you've earned your broker income, you've got leftover cash. You're going to invest passively. The passive investment itself does not trigger any tax advantage. Right? And I'll tell you, it's actually neutral to your personal model if your accountant knows how to make it neutral. If your accountant doesn't understand the area, you actually have a worse tax result with corporate passive income. So corporate passive income, so getting interest income, dividend income, rental income, these are all passive incomes, face a corporate tax rate of slightly greater than 50%. Well, that's way worse than most people's personal tax rates. But it's brought back to the personal rate if you disperse the corporate passive income to the shareholder that year. So you have to know how to do this, is what I'm getting at. But you're not getting a benefit on the passive income, it's the active income. A few questions came through. Yeah, again, Andrew mentioned you do T4s based on when the cash was received. So your industry has always taxed the income based on when it's been received, which dramatically lowers the risk of that previous question of can the corporation absorb some income for a deal that was closed in August but paid in November. So it reduces the risk. Good point, Andrew. Okay, question came in. If we have a current corporate family as equity shareholders and we create a real estate corp, can we move money from the real estate corp to this thing corp? Yeah, there's certainly ways to do that. What your existing corporation could provide management services for the real estate corp and then bill that service across. What you're getting is shuffling some income from your real estate corp to your management corp and paying out dividends through your non. I do this with I have a karate school and an accounting firm, and my accounting firm does not allow family. I don't have any ability in my professional corporation. I have a professional corporation. I know what I'm talking. I know the practical side of this. My professional corporation under my college does not allow any shareholder but a CPA or CA, very snobbish profession. So in my case, I also have a karate school. And so I shuffle income from my accounting firm to my karate school and then pay dividends to my family through my karate school. The issue is, what is the rationale for shuffling the income from your real estate firm to your other company? Under tax law, shuffling of income must be fair market value. Of course, people just take risk on and do anything they want and get away with it. That's certainly one angle. But if you get looked at, you have to have an identifiable reason for that shuffling of income. In my case, my karate club refers an awful lot of clients to my accounting firm, so I have a referral fee goes across. Your case, it's probably going to be some kind of a management service contract where your corporation may have your kids involved and they do work for your real estate firm. That's what justifies a billing. So, okay, do we put in a class of share? Do we put in Class B shares for tax benefits? Well, again, Class B shares, I assume, are non-voting shares. Those allow you to pay dividends to the other shareholders. So, you as the broker owns the common shares. Your partner and 2 adult children own non-voting, these B shares, and that allows you to pay dividends to them, subject to the risk of dividends being challenged for being unreasonable. Another question came through, can one PREC corporation be owned by 2 realtors? I don't know that answer. That's a college issue. I suspect the answer is yes. My college allows. Does anybody know the answer to that one?
Yeah, the answer is no to that one.
Okay.
Another piece of information going back was it has to be registered provincially.
Okay, provincially. Okay, so that's very common. Almost every professional corporation we've seen is a provincial registration so far. So just so you all know, provincial corporations take a little bit longer to form than federal ones because the Ontario government is slow as can be with them. So, okay, I think so. Yeah, so no 2 realtors. In my profession, we can have multiple CAs owning shares in the same firm. Now, I guess in your case, it does make sense. In my case, accounting firms do get bigger in that. In your case, it's more of an individual model. Can we use the income from the Prereq to invest in passive real estate investment? That is a question your body has to answer. All other professional corporations, the answer is yes. Is your body going to restrict this because it's too close to what you do? I don't know. Again, maybe time will. I don't know if everybody, Andrew, have seen anything on this, Andrew?
I think so. Are you done? Are you done your slides?
Almost, yeah.
Okay. Almost?
An example, that's all I think.
When you're done, we have a RICO checklist document that was provided by RICO that had some of these answers. And for example, the answer to the question about invest in passive real estate, there's one of the checklist items. It sounds like it might be talking to that, but I would be interested in your interpretation on it.
Sure. Yeah. So, next slide. Okay, this was one very quick comment. You may have heard this, and I want to always clarify the rumors you'll hear. So when Trudeau and Morneau did their dog and pony show a couple of years ago around the country, they were threatening to heavily tax passive income in a corporation to eliminate a lot of this benefit we're talking about. You defer tax, you open an investment account, you buy a real estate property, you get all kinds of benefits. They backed off. And they dramatically backed off, and they agreed that every small company should be able to build up at least $1 million of investment capital. They used a 5% rate of return and said $50,000 of investment income before you start to lose some of the 12% tax rate, 12.2%. So there's a lot of scope. Okay, there was a threat to tax every dollar of investment income at 73%. They backed off and they came back with, okay, we'll give you $1 million of capital to invest, like a pension plan your corporation can form for you. Once you get over $1 million, you may get some minor negative tax hitting you. We won't point talking about that today. So I gave a couple of examples here to put some math on the table. It's always easy to talk about theory. So I mean, obviously, all the benefits get better as your income gets higher. All right. So we have to use a little bit of the higher income examples to show the benefits more. But here's a case where a broker earns $300,000 in a year. If you're unincorporated personal tax, but this is before any RRSPs and that, about $125,000 of personal tax on the tax bill. If you only need $150 to live, now living always includes filling your RRSP. So fill your RRSP first. We can talk about that later on. But so in that case, you pull out $150 from your corporation, leave $150 in the corporation. The tax payable falls by $63,000. Now you're going to feel really good. It's always nice to write a smaller check to see you got $63,000 more to work with in your business. If you're hiring employees, you can hire one more employee. You can grow your business that much faster. If you're buying properties and you're buying a building, you got more capital. Okay. If you're going to invest passively, all you're doing is deferring tax to invest passively. You've got $63,000 more to go to, I think it's Vicky who's talking on the Sun Life side, go to Vicky with and invest, and hopefully you earn 5% more per year, 5% on that capital. So you've got additional investment income. So this is leveraging 101. Who are you borrowing from? I know you guys can't answer, but you're borrowing from the government. It's leveraging principle. You're borrowing at 0% interest and taking that money and investing it. Okay, not hard to do. Now, the real benefit, this is a small benefit. It's still pretty big in this example. It's $3,200 per year added on every year. So over time, I look after a lot of cardiologists. We defer $100,000 of tax a year for them. Right? They're big income earners. Okay? These results seem too sweet to be true, which is why the government did their dog and pony show, but they backed off. Now, if you income smooth, so this is a concept on retirement. If you leave those funds in the corporation and draw them out when you retire or when you're earning less money, you can reduce the tax bill, permanent tax savings. You would have paid 54% tax on some of the $300,000. You can take it to a year where your tax rate is 40%. You will then have a tax bill savings of 14% tax on $80,000 and 12% on $70,000 because you smooth the income. You won't earn $300,000 your entire career. If you do, this includes retirement. If you do, wonderful. Most people don't have that result. In their retirement years, earnings are less or they have bad business years. So in this case, you've deferred and saved. There's nothing in the personal model that allows this. Now, if you're going to earn $80,000 a year, forming a corporation, when you have to pull $80,000 out of it, it's not going to have these benefits. You'd have the benefit of reducing Canada Pension Plan off the table in that model. Okay. Now, one more example. This is a bit more of the smoothing one. So Canada's tax system is flawed. Again, these are an extreme result, but not likely to occur. But if you have this situation where your earnings fluctuate, $300,000 one year, $100,000 year two, the personal model has an tax obligation of $150,000 in that case. The smooth model has an obligation of $140,000. So a $10,000 tax by taxing the income appropriately over the smooth issue in 2 years versus a personal model which has no options. So again, these are all benefits. How much they benefit you always is driven by how much you're earning, family situation, etc. Okay, the example here, single family, 150 and income. Can salary pay the both spouse $75K per year? No, you can pay your spouse a salary for the work they're doing. And I'll tell you, salaries paid to spouses seem to draw no attention whatsoever from CRA. They could. The drawback of paying a salary is, again, drawback, you're paying Canada Pension Plan on the salary. But again, yes, your key point in income splitting is to make sure that each spouse is in the same tax bracket through whether you pay a dividend or a salary or a consulting fee to your spouse. And the children then come into play. What can you justify paying your kids? Your kids have low tax rates. Your spouse may have a lower tax rate than you. So income splitting is just about getting everybody into the same tax bracket where possible, whether it's salary or dividends. The only difference between salary and dividends is that salary attracts Canada Pension Plan, dividends do not. Okay, so you have the extra payment of CPP for salary. In theory, both salary and dividends need to be reasonable in the circumstances. In practice, so the practical side, there is very little challenging. I've been in practice 24 years. I run a very broad, comprehensive practice. So I have a lot of clients. I have yet in 24 years to lose a reasonableness test on compensation to a spouse. But I'll also tell you in 24, I only faced 2 challenges. It's almost never. Now, if somebody wants to make life miserable for you, pay an unreasonable salary to your spouse, they can reverse it and put it into your taxes. Again, it's theoretically can be done. Practically, it is pretty low risk stuff. What your accountant should do is give you the options and you decide on the risk. Your accountant should never say you can't do something. It should be, here are the options, here are the risk elements, you decide which risk bucket to take. A salary is a lower risk bucket than dividends because CRA loves T4s, which is salary. Okay. Any other questions? Okay, I just had some administrative steps. Okay, I'm not going to go too fast on this. Legally form your corporation, register your corporation with your association. You should have a corporate bank account. You will incur a minor bank cost from another bank account. Okay, make sure your brokerage firm is aware of this status and you'll deal with them when they pay your corporate bank account. Where possible, once you're incorporated, act like a corporation where possible. So document where possible transaction flow in your corporate name. So if you're hiring an employee, they're paid from the corporate bank account. Doesn't mean you can't pay bills on your personal credit card, you can't use cash, but when you write checks for costs, use your corporate bank account. A corporate credit card is not necessary, but it's available. Structure your personal tax compensation. All you have added on is the corporate tax filing. The HST is already there. And you'll need to close down your personal HST account. Question came through, what's the legal age for a child to receive dividends? Okay, legally, they cannot subscribe to shares until they're 18 years old. But if you ever did pay a dividend to a minor child somehow, okay, there is something in the Tax Act. It's actually called kiddie tax. That's the slang term. It's called tax on split income. So if you pay a dividend from a corporation you control to a minor child, so your lawyer facilitates this process. CRA won't challenge you, but there is a tax rate on a dividend paid to a minor child that comes to the same as dividend paid to you. Okay, so yes, you can. The general answer is don't pay dividends to minor kids. They're of no value to you. Right? But if you do it, like, there's nothing stopping a minor child from actually getting a dividend from a public company. Minor kids can have money and then if invest money. In your own company, the kiddie tax applies. The kiddie tax is called tax on split income. So I think that's it. Is it? Yes, that's it. Anybody have any other questions? I think, Andrew, you wanted to bring up that slide on the what they were allowing, or the
what Steve's talking about, Andrew, is the RICO checklist that you mentioned, right? Mm-hmm.
Kiddie tax rate is basically your tax rate. So it puts the income back into your hands, basically. So the RICO checklist, it'll probably get changed as things evolve, but so we have anything here on assets your corporation can hold. So they'll always have some clause about you can only, you can't sell hot dogs in your corporation. That's active. Okay, that's the active side. You can't take your corporation and do a bunch of other businesses. But this is the passive side. Okay, nothing much there. Yeah, I didn't see anything there.
Yeah, muted there. And I've got some questions that people have sent in, Steve, that I'm happy to ask for on their behalf as well.
Sure. Okay, fire away.
Okay, yeah, great information, Steve. This has been fantastic. And I think this is one of these topics, and I'm sure others will agree, is perhaps we don't know enough, so we don't know what to ask until we start getting some of the information in. So some of the questions that came in that were sent in, you answered a lot of them, but one of them, can both realtors, so in a husband and wife instance where they're both registered as realtors, can they both use the same PREC or the same corporation, or does it have to be individual to take the benefits of it?
Yeah, I don't know the answer to that one. I suspect from what was described earlier that it has to be individual. But again, that's not a tax issue. It is an issue with your professional body as to what they allow. Again, my professional body allows me and my 3 partners to all be CAs in the same CA firm and only have one corporation. I suspect in your model, likely not, but given the way your industry operates, and that the broker is a broker on their own. But again, it's something I'll have to check with the legislation. It looks
based on the checklist. I think the first 3 kind of cover that. The second, third, and fourth corporation has one person. One single controlling shareholder who owns all the equity shares, which are the voting shares.
Pretty limiting there. Which it does make sense given how your industry operates. That it's an individual broker, and our industry is dominated by firms, right? So,
and Steve, to our earlier point, this is exactly why we're taking all the proper steps to make sure that when we roll this out, we have a checklist in place, and that we have all the compliance items that we will require in order to make sure that all the people that are in a PREC are doing it the right way. It's going to be safeguarding for both them and for us. So you can see that we're going to be getting information from an accounting perspective, from, of course, a RICO perspective, from a financial planner's perspective, and from a lawyer's perspective. And then we're going to put it all together to make sure that you're all really well looked after. This is very important. And I think to Gary's earlier point, Steve, that was very comprehensive what you went through. And again, we're getting lots of great questions because everyone's been waiting for this for a very long time. And according to what Steve said, and you've seen it even with COVID protocols, things are rapidly changing. So we're going to be on top of it to make sure that when we do roll it out, we do our best to make sure that it's done in accordance with all the governing bodies and the rules that are applicable. So
follow those rules. I will comment that with all the professional corporations we work with, engineers, lawyers, doctors, it seems to be that as long as you just stick to your business and invest your capital, there is I'm not going to say you won't get any attention, but you really don't see the colleges doing anything of substance. I've been a professional corporation for 20 years. My college has never, ever, ever examined anything. And I actually get inspected. I actually get physically inspected every 3 years, a thorough inspection. I have to pay for it. It's a $10,000 inspection. And they never look at my corporate structure. But again, it's like everything else. I'm not sure how your college will be. And here was more question that came through. I think a question came through. I wanted to answer. It said, I guess the guidelines had mentioned you cannot be paid more from the corporation than what your corporation earns. In other words, that's just you can't put yourself into a loss position. How does that help with deferral in a bad year? That's the opposite. Deferral means leaving money in the company. So earning $100,000 in commissions and only taking out $50,000. That's where a deferral exists. If you pay yourself more than you've earned, that's not a deferral. That's taxing money in advance. So that question, I think, is misinterpreting. A deferral exists when you leave money in your company, and your college will always allow that. They don't want you to bankrupt that clause they wrote in there where you can't pay yourself more than you earn is a clause to prevent you from bankrupting your company, which is I earn $1 and I pay myself $1.20. Well, then eventually your corporation will be bankrupt and you will be against the reputation of the profession. You will look bad. Another question came through, do I need a certificate from RICO in order to operate under the I suspect you'll need something. The normal structure, again, I only speak what we do with lawyers, doctors, is you form your corporation first legally, and then you apply to your college to be able to use your corporation. I assume you will have a similar process. So the corporation comes first. If you have the wrong name, they will tell you to fix your name. They'll look at your share structure. So
I'm not 100% sure on this answer, but I believe that your registration with the college will always stay in your personal name still. And although you do have to notify RICO the name and the address for service of your PREC before remuneration can be paid to it. So you have to notify them, but I think when they go and check your registration on RICO, it'll always be your personal name.
And to that story, Ontario, my corporation is a firm that's separate from me.
And to that point, Andrew and Marvin and I were chatting earlier, and it was one of almost a realization that as registered real estate registrants in the province of Ontario, we are, as individuals, we're the one that holds the license, not our corporation, right? So, which is to say that your independent contractors agreement will always reference you as the registrant. And that's something that Marvin and Andrew and I and the lawyers will look at and amending that contract so we have something in place that allows the flow of commissions into that newly formed corporation.
Exactly. And to add to your point, Gary, I think a bit of a plug for Steve. I would certainly encourage everybody on this call that wants to go through the incorporation process for a personal real estate corporation to reach out to Steve. And maybe, Steve, you can, because potentially you could have, we have 450 agents, so potentially you could have a big inflow of inquiries. So do you maybe want to comment on how people should go about contacting you if they're interested in you assisting them in this regard?
Yeah, well, I mean, you can email me, phone me, no issue. We will help anybody out. What we do when we help clients form companies, one, decide whether it's your lawyer incorporating you or we incorporate a company for you. The reason why we incorporate companies because lawyers run the tax structure through us all the time. And so we actually have to be fully involved, and we actually have to actually redo a lot of them because lawyers don't know the tax structuring. And so it's always the element of working together. And we set up all the CRA accounts and set up compensation structures for clients. But, we don't charge for talking about initial consultations and that. Christina sent my email address to you guys. So we're very flexible in getting you started. The delay is with a couple of delays occur with a provincial corporation. You cannot do it online. Well, they're starting to do an online process. We can get a federal company up and running for a client in 24 hours. Provincial companies take longer. Plus, it has to then go to your body to be blessed before you can start using the corporation leaked under your professional body. So a couple more questions came through. Okay.
Yeah, Steve, I think a great question there is at what income level or perhaps profit level does this make sense? I know you touched on the numbers a little bit earlier, but I think that's a good, valid question.
I agree. That's a great question.
Yeah, it's going to vary. In regards to a minimum level, obviously, eliminating Canada Pension Plan could be something that you want to do at relatively low levels of income. But remember, you got to pay the cost of doing this. So until Canada Pension Plan gets to be $2,000, that's what it's going to cost you to run this empire. Extra cost. So you'd need $25,000 of earnings. That Canada Pension Plan is there for $2,000 on to make yourself cash flow neutral. And that wouldn't be such a great result, but at least you're not costing you anything in the short term. The tax payable situation, you're not going to get any income tax benefits, so tax savings potential, until you're at least above the first personal tax bracket, which is close. It's not an exact number because federal and provincial differ, but in the range of $45,000 of personal net income. Now, even then, the benefits are pretty marginal. So let's not jump up and down at $50K to incorporate. All right. So, but the personal tax rate jumps to 31% at that level of income. The corporate rate is 12.2. There's enough of a gap there. But the real kicker here is you have to be able to leave profit in the company model for any tax savings to materialize. So if you're going to earn 60K and live on 60K, that's not leaving money in the corporate model. Yeah, you could avoid the Canada Pension Plan. That may be worthwhile. I always advise clients, don't pay Canada Pension Plan when you can't pay your bills or you're trying to build your business model up. That $6,000 is much better being spent on marketing efforts than going into CPP at this age. You can catch up later on. Not against CPP. Not against CPP. It's an investment decision that occurs too early in people's lives. So that certainly you would see most of the benefits occurring when income gets to be above $90,000 level. But again, it's not a magic point. You can again kill $3,000 CPP at $35,000 of income with a corporation, if that's one of your goals. Liability protection occurs at ground zero, right? Mathematically, though, you won't see a lot of benefits at income levels where you're earning enough to live. Okay, it's where you're earning excess earnings is where the real income level benefits will occur. But when I have clients come into my office and I ask them how they're paying their bills and they're struggling, we incorporate them right away to avoid CPP. You should not be borrowing on credit cards at 18% to fund the Canada Pension Plan contribution. That's a disastrous financial result long-term wise. And that happens to a lot of people in the economy. So if you are struggling financially in the early stages of your career, you have an incentive to incorporate early. Well, it doesn't make any sense tax-wise. Yeah, but I shouldn't be putting this money into the Canada Pension Plan bucket at this stage of my life. Even though I want to, I can't afford to.
So, Steve, I have a question for you. I think, is it line 151 that our realtors will be looking at on their current personal tax return to see their net income. Is that the right line number?
Line 150. Yeah.
150. Yeah, I added one for inflation in case.
Yeah. I don't know. It's one. Well, that one. Yeah, it's around one.
Then so line 150, if it's reading 45, so you're saying if line 150 is reading 45,000, it's kind of the minimum, but at 90,000, that's.
Yeah, I still caution that if you're a young, starting out broker and you really want to make a go of this, do you want to kill the Canada Pension Plan? And how much income do you need? Where the CPP payable is the same as the professional. It's about 25,000 of income. So somebody who earns $40,000 a year has to pay 3,500 of CPP. And if they went to a corporate model, they kill that cost. They pay $2,000 for accounting. They got $1,500 more to grow their business. That's not a big number, I know, but it's still positive. If every dollar going back into your business generates the potential for more success. I started my business from scratch, and believe me, the best investment I made was in my own business. Right? There's no comparison when you're successful. So, Canada Pension Plan is not a good choice in that decision process. Or if you're struggling to pay your bills, which we got to be honest with yourself. If you are living on credits, you should not be putting money in the CPP. You never save for retirement with borrowed money on heavy credits. That's a flaw. And Canada Pension Plan has that flaw. It forces you to put money in when there's no money to save. It is a pension plan in the end. It's all that it is. Okay, it's not a tax. It's a pension plan. Put money in, get money out. It's the same way any pension plan works. This one, people don't have an option usually. Okay, I think I got the contact info there. There was a question here, seeing a real estate situation.
Perfect, Steve. So there's one thing I wanted to just highlight there, and then Andrew Bolton has a question. So feel free to unmute yourself there, Mr. Bolton. What you said and what Marv alluded to as well was the net. What agents that, so many times do we hear gross commission of 100 or 200,000, but it's what you net.
It's what you net after business expenses.
Exactly. Yeah.
Which you guys have, you guys have healthy business costs. You're real business people. You have to spend money on marketing and travel costs and entertaining costs. You're a real business person. So it's the net, not the gross. Very important points. Gary.
Mr. Bolton, over to you.
Hey, Steve, thanks so much for the information. It's been awesome. I wanted to, I think, expand upon that regulation that says that the PREC can't pay more than we make. And so how that would affect income blending over years. So for instance, let's say we made $300,000 in a PREC in 2020, and we only took out, let's say, 150 in that year. But then the following year, we have something, I don't know, maybe a pandemic, and we make 50. So then we want to pull out some of that 150 we saved from 2020 and 2021. But we only made 50 in 2021, and we're going to pay ourselves more than we're making to do that cash blending so that we minimize our tax exposure. Does that regulation not stop us from the ability to do that?
I can't imagine they don't mean a cumulative number here.
Okay.
I just, I know it's a good question, Andrew. I just, under every element of corporate, and I know that the comment is geared towards not bankrupting your company. Okay, so if you I'm sure it must be a cumulative issue that if you have 300,000 year one and 100 year two, you've got 400 to pull out relative to those 2 years. I know I could be wrong, but I just can't fathom. It wouldn't make any sense. It would eliminate one of the major benefits to incorporating. They didn't allow you to work with your total income over time. And I no college has ever brought that kind of I know every college has the same clause, which is they don't say it exactly the same way. They basically, you cannot put your company into a bankruptcy position by drawing out more than you earn. So it may have to be double checked, but I would certainly be shocked if it wasn't a cumulative number. So what you haven't drawn out year one can be drawn out year two in that regard. So that's something we'll have to look into.
It's like the most major benefit of doing the structure, essentially.
Yeah. It just wouldn't make any sense in it that they would say it's got to be pulled out every year. It just would defeat the purpose. I mean, your profession's your profession's not a passive profession. You're bright people, and they're not. You're more of on. I mean, you're salespeople, right? So you're not passive in nature. And I can't imagine your profession. I have the passive profession, right? And my college has no restriction like that. That's for sure.
Okay, thanks so much.
Okay, no problem at all. So somebody had a question about probate. Will the probate tax rate be reasonable, and are there any advantages for the estate? So, a corporate one thing about corporate shares, okay, which I didn't get into the probate side, but we should talk about it. Corporate shares can avoid probate and your lawyer can comment on this, but I'll talk about it. If you have a secondary will that has just your corporate shares in it, your corporate shares aren't probated. So what that means is that if you had $2 million in your professional corporation, in your PREC, you can actually avoid probate if you want to by having a second will. Shares still go to your kids or your spouse, but they're not probated. Secondary will with corporate shares is not probated. Lawyers talk more about that than I should. But otherwise, it's still the same probate rate, 1.5%. So corporate shares are an asset you own. The value of the asset would be the value of your company. The company has $2 million in there when you pass away. It would be $2 million of value. That would be the probate amount. But it can be actually avoided. A corporation, I didn't mention this, benefits, okay, because it's not that big and it's way, way down the road. But if you have $2 million in your corporation, you can avoid $30,000 of probate under a corporate structure by having your secondary will with the corporate shares. Hey, it's worth something. It's so far down the road and it's so small relative to the rest of them. But you can avoid probate on the corporate assets is the basic answer.
Perfect. Well, why don't it's getting down to the bottom of the half hour here, and I got one last question. Then maybe we'll throw it back to Marvin to thank everybody and wrap it up there, Marv. One of the last questions here, Steve, is, and we talked a little bit about the corporation owning some assets, and one of the other questions, actually from Andrew Bolton, can the PREC take out insurance policies on realtors?
So that corporation buy an insurance policy on a realtor. So somebody's working for the corporation?
Yeah, or the individual owner.
Oh, yeah. I mean, corporate. I mean, I can't imagine your college having any problem with that. It's not really an asset, and that's a protection tool. So I cannot imagine your corporation wouldn't allow you to buy reasonable real estate. It's a reasonable insurance. Insurance in a corporation is a lot of misleading stuff here. It fundamentally has the same tax result as insurance bought personally, which is tax-free. Right? Canada has what's called a source concept. So you can't buy insurance, life insurance, with the intention to make money off of it. Well, unless you were planning to knock somebody off and they could prove it, right? So, whenever you have life insurance, whether it comes to a corporation or not, it's tax-free. What a corporation can do, though, is fund the premium. So if you have an expensive insurance policy, it's going to cost you $10,000 a year. You have to earn $20,000 of personal income, pay tax of 50% to have $10,000 left to buy your insurance. In a corporate model, if the corporation is the beneficiary of the policy, then the corporation can fund it with corporate dollars. So you'd only need to earn $13,000, pay $3,000 of tax to have $10,000 left to pay the premiums. Bottom line is corporate insurance is very common. It gets the same income tax result, and it's tax-free money to the recipients when it gets paid out, if it's life insurance. There's a slight perk in using corporate dollars to buy life insurance. But again, then the corporation becomes the beneficiary. That's not always the results you want. In other words, you buy insurance on one of your agents, but if it's to protect your agent's spouse, for example, the money goes to the corporation, not to the agent's spouse. And the corporation then must disperse it to the spouse. There are steps to doing that. Plus, look, I have 4 business partners. I don't want most of my life insurance from my wife going into my accounting firm. I don't want her to have to go after my business partners to pay her. So I buy most of my insurance personally and spend a little bit more money doing it. So just keep in mind that corporate insurance has pluses and minuses, and people are always sold pluses, especially by insurance brokers. It's kind of thing you want to run past somebody who knows more. But generally speaking, there's nothing stopping you, and it's very common. If you have to insure a broker to protect your business model, then that insurance should be paid to the corporation. Right? You don't want to lose a major income source as one of your employees/sales representatives disappears through death. You want a compensation to keep your business model strong. That's true corporate insurance. If the purpose is to pay their spouse, you may want to consider a personal policy just to have the spouse not having to possibly. I mean, Gary, what happens if your kids you're killed at the same time and your son inherits the shares in the company? And your son likes the money and it comes in. He has no obligation to pay out the insurance. It belongs to the company. Right? So I'm giving you a bad example, but it's a corporate asset until it's dispersed. And so it does not belong to the benefit. The beneficiary is the corporation in that case. To get the tax benefit, the beneficiary must be the corporation. Otherwise, life insurance is tax-free in Canada either way because it can't be bought with the intention to make money. Okay, so it's a tax-free windfall, whether it's corporate or personally held. So be careful when you get into corporate insurance. You understand the pros and cons. That way you'll make a good choice on it. But yes, you can certainly insure. Their insurance requirements can be carried through. But people think it's a benefit. It's not a benefit of any substance having corporate insurance versus it's a minor benefit is the best way to. Minor benefit with some other costs. So
great. Thank you. Marvin.
Well, I want to say, first of all, thank you to Steve. He wrote I sent him the general information that we knew when this was coming out, and he took the time to write a very comprehensive reply, which prompted us to say, man, we got to get you in front of everybody. And he was kind enough to alter his schedule and do so on very short notice. My understanding is this is before anybody else has rolled it out. So
you guys are leading edge. See, good.
Well, thank you. And we do appreciate your expertise. So what I would say to everybody on the call is, first of all, we have recorded this. We are going to be sharing this information through Gary and Andrew. You will have inquiries, no doubt. If you're a guest on the call, you're also welcome to contact Gary or Andrew, depending on which area you're in. Certainly, we've opened up the ability to speak with Steve and not only consult him, but obviously retain him for your corporation as well. We have 2 more segments coming up, as Andrew mentioned at the beginning of this. So by next week, we should have everything sort of sorted out, and then we'll start taking measures internally as far as our company is concerned to be prepared for when you come to us with the request and all of the boxes checked, so to speak, for your personal real estate corporation. So I want to thank you all. I compliment you for being on this call. It's very important on the Zoom call. Once again, thank you, Andrew, Gary, and thank you so much, Steve, for all that you've done to help us all out today. We look forward to seeing you all real soon. Thank you so much.
Thank you.